Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's on YouTube for you to watch. Now, if you're not on my free email list, go into the description of this video and you'll see a link to join it. And then every single trading day before the opening bell, you'll get an email from me with my uh, market commentary and also links to all the top stories of the day that you need to know about to be up to date and up to speed on what's going on in the markets. Now, today, I want to do a quick video update. I want to talk about what's going on in the S&P 500 now, what's going on in the price of gold, what type of predictions different people are actually making about the economy and the stock market. And then we're going to talk about my public portfolio that I just started in May during what's a very volatile time and challenging time in the stock market. In fact, Robinhood, when they released their earnings report for the first quarter of this year, they revealed that millions of Robinhood traders have stopped trading. They've blown their accounts up to representing roughly 11% of their customers. So the declines in the stock market, and we're in a bear market, and I define a bear market as a market trading below its 200-day moving averages. And when that happens, those moving averages act as resistance. And that's what happened in 2007 to 2009. It happened from 2000 to 2003. It also happened with gold stocks from about 2012 to 2016, agriculture commodities from around 2012 to last year, to 2020, and so forth. It's a really classic way to determine what the trend is. And when the market's trading below that, it becomes a very challenging environment. Most people end up losing money when they sit there and they're holding, or when they try to buy something and expect it to go up, and then you just get a rally and it fizzles out. And as a result, a lot of people stop trading, or else they try to turn themselves into day traders. They don't want to hold anymore, and for good reason, because often, and we've been seeing this, you have stocks actually start to gap down on bad earnings. Just last, January, Facebook crashed over 20% a day. Last month, Walmart and Target had substantial price drops. Target crashed in one single day over 20%. Netflix crashed too, over 25% twice this year. So it's tough times. And people are scared to be in stocks that do that, but not every sector of the market is doing that. Energy stocks, oil stocks are among the top performing sectors this year, and their stocks are not crashing. They're going up, up, and up. The sector as a whole made a new 52-week high last week, and their earnings for energy companies are exploding. There is always a bull market somewhere, and if you want to beat the market, the way to do it is to focus on the things being the market. That's my philosophy. A year ago, people were getting into trading in 2020, and afterwards, they saw the stock market go up, and much of the commentary on social media, on Facebook, was showing you here are big gains made very quickly in individual stocks. That influenced people into thinking that, hey, I can get rich quick. All I got to do is get in the top stock. Well, that game ended, and that type of thinking of I'm going to get rich in a stock is long gone, and you're seeing these stocks just blow up so often. But you got to abandon that mentality and think about, instead of getting rich quick, how am I going to beat the market? Because if you think like that, you're then thinking like a professional money manager. And if you can beat the market, you're going to make a lot of money with compounding returns, over years. And that's what I'm here to try to help you to do. That's why I started my public portfolio at the 1st of May. Let's look at some of the charts and see what is going on here. So first, this is this is the chart of the S&P 500. And the blue line is the 50-day moving average. The green line is the 200-day moving average. We fell below that in January, tried to couldn't stay above it for more than 2 or 3 weeks in February and also March, and then dumped. A big decline. The S&P broke through support of 4,200 in May, and then it had a rally 2 weeks ago. That rally brought a lot of calls of a bottom, an end of the decline, and a lot of predictions that I'll mention or show you to try to create a scenario of expecting the stock market to go up in a big way. But last week, the stock market did nothing. It closed just about where it opened up at on Monday. So sideways action defined last week. That's not too shocking, because when you see the market move up like it did the week before in a couple of days, typically you then get sideways price action. And we're overbought now. The indicator on the top is an oscillator indicator, the daily stochastics. It began the week above 80, overbought. And when it's overbought in a bear market, it typically stalls out. The last time it did that was in March. And now the most likely scenario, just based on the trend of the market that's already in, which is bearish, is that, we probably go sideways a few more days, maybe even a week or two, and then tip back down, or at least retest the May lows, probably go through them. And because what I'm looking at is the long-term trend shifted to bear. When the 200-day moving averages are now resistance, you're trading below all the moving averages. Even with the recent rally, we're not above the 50-day moving average. Very big bear market. When you're in a bear market, then the shorter term trends, which are what the stochastics are showing us, overbought, that's bearish. If this was a bull market trading above the 200-day moving averages and the stochastics were below 20, oversold, I would be doing a video saying, hey, this is a buy dip time. But it's not, because we're not in that type of market environment. And what has happened, though, is 2 weeks ago when the market started to go up, people look, one of the problems with the market is inflation, and rising interest rates is hurting the stock market. The inflation is hurting consumers. And these are trends that have no sign of coming to an end. There's no evidence that they're coming to an end. And historically, interest rates have had to go above the rate of inflation before inflation would really go away. And we're so far below them that the reality of the way things are suggests that inflation is not something that's going to go away overnight, but something that's going to take several years before it really goes back down to 2% or lower. So, but that's all negative for the stock market. And so what happened 2 weeks ago, a lot of people that are bullish on the market, they want the market to go up because they manage money, they run funds, and if the market goes up, their funds go up, they make more money. If the market goes down, they can lose investors, therefore make less money, even be danger of losing their jobs. They wanted to believe and encourage people to believe that this is all bullish, that the rally is real. So they came out with a lot of predictions. And I'll give you an example of what I'm talking about. This is a slide from a presentation Cathie Wood did on May the 20th to her people. And she's so popular because so many people own her ARK ETF. And she created a big name of herself by speaking about futuristic predictions after 2020. and her fund did well. She invested in very speculative stocks that did go up, but now they're going down just as quickly as they went up. But anyway, what she did was she delivered a presentation claiming, predicting that inflation would completely collapse. You can see this in her slide. Core CPI, with her prediction, would collapse back down to 1%. In just 2 years, peaking out immediately. Her headline CPI going back down to basically 3% in 2 years, going down, just straight down and crashing. This is her prediction. And she used that prediction to justify to her people to buy her fund, to put more money in her fund and claim that it would go up. Now, what you need to know when you're trading the market, when you're investing in the market, people make all sorts of predictions of market declines, market rallies, and then they create scenarios to justify them. But more often than not, which is what she's doing, they have absolutely no real statistical evidence to justify their predictions. They simply make them because they are creating scenarios that they want you to believe and they want to convince themselves are real. What you need to do is forget about predictions. Stock market predictions and economic predictions like she's making here are completely useless. They are, in fact, complete and total garbage. What you need to do is identify the larger trends of the markets. And there's multiple markets. You got stocks, you got bonds, you got commodities, you got gold, you got foreign markets, you got individual sectors inside the stock market. Analyze all these things and figure out the trends they're in. If you want to be buying, buy things in bull markets on dips. And if you are holding things that are lagging the S&P 500, falling more than the S&P 500 when it declines and rallying less when it rallies, you are in a recipe to lose a lot of money because when the market pulls back, you get crushed. What I just said, roll back the video. That is the key to making money. And then you keep your hand on the trends. And then when the trends change, you see it change. You're not trying to predict what's happening or going to happen. You see what's happening. You adjust, you adapt to that. That is how you navigate the market. That's how you beat the market, along with money management strategies. How much money do you put in an individual stock? How much do you want to invest in an exchange traded fund or any sort of fund? And how well are you going to diversify in a mix of things that aren't all trading together? Again, roll back what I just said, because that is the secret to beating the markets and making money in a sustainable way and not getting sucked down into bear markets and losing your butt. So these predictions are useless. And she is one of the worst financial commentators out there. And her fund is a total disaster. This is the ARK ETF, total collapse. It was at 100, over at 125 around Thanksgiving or right before Thanksgiving, and it fell down to 35. A total disaster. And what she's doing is just delivering people these garbage predictions to tell them, hold on, hold on, hold on. The trend is down. There's no sign that the trend for this fund has shifted. This fund is a millstone on people's necks in their investment accounts. It's garbage. Get out if you're in it. Now, one of the things, what I did in May is I wanted to try to help people by, using a public portfolio. I couldn't get fully invested because I didn't think May was a great time to do that the way the markets are. And I don't think today's a great time to do that too. So my objective is to begin the portfolio and over time, get it fully invested. But I did it by, taking a very defensive stance. 37% is in a fund ETF that's in simply 3-month treasury bills. And I did that not to make money, but just to park it in something that's the equivalent of cash, close to 40%. 15% is in the DBA agriculture ETF. I own about the same position size in my own retirement account. 14% is in gold, IAU, same in my retirement account. And I got a short position, RWM, an ETF that shorts the Russell 2000, and PSQ that shorts the NASDAQ 100. These are one-time short ETFs. And what I essentially did then is put 40% in treasury bonds that I'm going to get out of to make more trades when I see something line up. And I'm like close to 30% long in commodities and gold, and close to 30% short in the stock market. I'm basically acting as it's a defensive position, because I think, look, we're in a bear market, and I want to be defensive. That's reality. And this is very similar to how my main account with most of my money is positioned, both long and short. But now, I may short more. We'll see how this trades out. But if this goes sideways a couple of days, a week, I possibly would do more short positions. We'll see. You just have to see what happens with this market. With gold, I really don't have a clear view for the short run what gold's going to do. I bought gold though because it's outperforming the S&P 500. Gold is actually up year to date, even though it pulled back in March. It's still up year to date, while the NASDAQ is still down, I think like 20% or something. S&P like 14, I think it is. But gold's up. And I think gold is going to be very bullish over the next couple of years. But for the next couple of weeks, possibly next couple of months, I'm not sure what it's going to do. Gold could dip down and retest 1800. It could fall to 1750. What I'm thinking of doing, I may add on more. I may buy more gold or buy silver if it does dip. But for the past 3 weeks, gold's sort of been trading with the stock market. So, I'm not sure what it's going to do. It could, just go sideways, and at some point, it's going to do what it did in January, February, and go up while the stock market's weak. And that, I think, will signal the next giant rally, the start of the next big rally that I think will take us back up to 2050 and probably even through that. But right now, it's just floating around, and it's just something I'm watching. So that's my view on gold and silver. Silver's trading in a similar manner. I'll load it up so you can see it. Here's silver. And then if we look at that DBA ETF, which I own, it's way above the 50-day and 200-day moving average. Energy stocks doing incredible. I do own a lot of energy stocks personally. Exxon is one of my biggest positions now. There's a huge difference between buying Exxon and buying the ARK ETF. It's because the fundamentals are completely different. The valuations for these tech stocks got crazy. Now, the valuations are contracting because earnings are bad. One of the holdings of ARK is Snap. Snap crashed last month. Coin is a holding. Coin crashed last month. The Coinbase, they laid off like 10% of their workforce because there's less people trading crypto, because crypto is in a bear market too. Bitcoin's in a bear market. If you want to beat the market, if you want to be serious about this game, get out of things lagging the market, get out of crypto, if you own Coinbase, get out of it. Focus on buying dips to the 200-day moving average and things trading by the 200-day moving average now in bull markets. If Exxon, that whenever it happens, it might be a year from now, but one day Exxon's going to dip to this 200-day moving average. Buy it then, and look for, so let's watch what gold and silver and the mining stocks do over the next couple of weeks and months, because I do think we will get a good trading position in them. I own them. I own positions in mining stocks and gold and gold, a little bit of silver, but I think there's going to be opportunity to buy more. So right now, I'm not planning on doing any trades Monday, Tuesday, Wednesday. Just watching the market, seeing what's happening. There's a good chance I will be doing a new position in my public portfolio. I'll let you know if I do. And it all depends on what the market does. You know, it may end up being adding another short ETF to it. So if I do that, you might want to think to yourself, okay, this guy's added a short ETF. He's doing well. He's beating the market. Maybe I'll do that, or maybe I'll buy some puts as hedges on long positions. There's all sorts of ways to play the game, but those are tactics. The key is making sure those tactics are, however you're entering and trading, how big the positions are, the tactics have got to be lined up with the trend of the markets that you're trading, or you're going to lose money and get out of this. I'm going to buy a lot of people already are getting out of the mentality of I'm not going to buy coin and try to hold it and make money. They were thinking that a year ago, or GameStop. They're thinking that a year ago. It's not working. So many people are thinking, okay, well, I'm going to day trade GameStop then. I'm going to day trade Tesla, you know. But I'm telling you, day trading, you know, is very difficult. Just trying to buy rallies and jump out because you don't think the market's going to go up for weeks. And it's very difficult. I'm saying, and I'm going to repeat as a wrap up, instead of day trading, why not try to buy dips in sectors and asset classes and in bull markets? Do that, because there are a few out there. And, you know, you just got to be patient and let the dips happen, let things come to you. So if you like this type of content, this video, please click like. Then YouTube knows people appreciate this. The problem is the YouTube algorithms, they're all lined up to deliver the videos or promote the videos that are the most popular, what the most people want, which is hype. They want to be told crazy predictions. They want Cathie Wood type talk. And I don't do that. And so YouTube doesn't really promote my videos out at all. But if you hit the like thing, that may tell them, okay, maybe we'll promote it to one other person today. So please hit that like button. And then if this is the first time you've seen me, hit the subscribe button and hit the bell next to that. And then YouTube will send you an alert as soon as my next video is put up for you.